68% of your savings account is already losing value. Not from theft, not from a crash, from doing absolutely nothing wrong. Over 340 million people in developed economies are sitting in the same trap right now, and their banks will never ever send them a warning letter about it. Central banks just held interest rates flat for the third consecutive quarter. Meanwhile, real consumer prices climbed another 4.3% in the same period. That gap between what your savings earns and what life actually costs has a name. Economists call it the silent tax. Most savers have never heard of it. Here is the twist nobody talks about at dinner. Your balance goes up, but what it can actually buy goes down faster. Every financial textbook calls this correct behavior, keeping a savings buffer. But past a specific threshold, that buffer quietly becomes a liability, not an asset. This is not one person's problem. This is a $14 trillion systemic blind spot. Across the US, UK, Canada, and Australia, the average household keeps 2.4 times more cash in savings than they should. There is an exact number, a ceiling, and almost no one knows what it is. Right now, across every major developed economy, central banks are caught in the same impossible position. Rates too high kills growth, rates too low ignites inflation. And either way, the ordinary saver is the one who pays the bill. The Federal Reserve, the Bank of England, and the European Central Bank have all signalled a higher-for-longer environment, which sounds like good news for savers until you read the fine print buried in paragraph 9 of the policy statement. Real yields, the actual purchasing power return after inflation, remain negative in 11 of the world's 15 largest economies, a condition that has persisted for over 31 consecutive months. This is not a temporary glitch in the system. This is the system working exactly as designed. And the design was never built with your savings account in mind. $14.7 trillion. That is the estimated volume of excess cash sitting in standard savings accounts across developed economies right now. Money earning an average of 1.2% annually against an inflation environment running at 3.8% to 4.6% depending on the country. That gap, 2.6 percentage points on the low end, translates to roughly $382 billion in purchasing power permanently destroyed every single year, not by market crashes, not by bad investments, but by the simple act of doing nothing and calling it being responsible. To put that number in human terms, it is the equivalent of every household in Germany, France, and the Netherlands, each quietly setting fire to $1,400 in cash on the 1st of January, and then wondering why their grocery bill feels heavier by December. The scale of this wealth transfer, from savers to the broader financial system, is one of the least discussed economic stories of the decade, and it accelerates every single quarter that rates lag behind real-world price growth. The real enemy in this story is not inflation itself. Inflation is just the weather. The real enemy is a concept called cash drag, the invisible performance penalty you pay for holding more liquid cash than your actual emergency needs require. And it compounds silently in the background of your financial life every single month. Cash drag does not show up as a line item on your bank statement. There is no fee, no notification, no red number. Your balance either grows slowly or stays flat, and the system is specifically designed so that nothing ever looks wrong, even as your real-world purchasing power erodes at the rate of a slow leak in a tire. The households hit hardest are not the irresponsible ones. They are the disciplined savers, the people who did everything their parents told them to do, who built up 6, 8, 12 months of expenses in a savings account and felt genuinely proud of it, not knowing that past a specific threshold, that discipline starts working against them. Understanding where that threshold sits and why it is where it is the entire point of this video. Conventional wisdom around savings was built in a different interest rate world. A world where your savings account at the local bank quietly returned 4%, 5%, even 6% annually. Where keeping cash felt like a genuine financial strategy, rather than a slow-motion concession to monetary policy. That world ended. The rulebook did not update with it. And so, an entire generation of financially responsible people is operating on instructions that were accurate 30 years ago and are quietly destructive today, following advice that made their parents wealthier and is making them relatively poorer. The number that changes everything. The ceiling above which savings stops protecting you and starts costing you is not a secret. It is not complicated, but it requires understanding one macro mechanism that most personal finance content deliberately skips because it makes the answer feel less comforting than just save more. That mechanism and the exact number it produces is what we are going to break down, starting right now. Most personal finance content on the internet is built around one goal: making you feel better about decisions you have already made. It confirms your existing behavior, validates your savings habit, and sends you away feeling responsible, which is great for watch time and terrible for your net worth 20 years from now. What this channel does differently is start with the macro mechanism, the large-scale economic force that is already in motion, and then trace exactly how that force lands in your specific bank account, your specific monthly budget, and your specific long-term financial trajectory, with numbers that are honest rather than comforting. The savings ceiling question is a perfect example of this approach, because the answer is not save less. That would be irresponsible advice. The answer is far more specific and far more actionable than that. And it comes directly from understanding how cash drag, real yield differentials, and opportunity cost interact at the household level. By the end of this video, you will have one number, your personal savings ceiling, and one clear next step. Not a 5-point plan, not a course to buy. One number and one action, grounded in the same macro framework that institutional investors use to manage their own liquid reserves. The framework we are using today is not complicated, but it is precise. It is the same logic that treasury departments at mid-size corporations use when deciding how much cash to keep liquid versus deployed, scaled down to the household level and expressed in terms that require no financial background to apply. We are going to look at two real-world paths: same income, same starting point, same level of financial discipline, and watch what happens over a decade when one household knows the ceiling and one household does not. The gap in outcome will be specific, it will be expressed in dollars, and it will be larger than you expect. Everything that follows builds toward one practical conclusion, a conclusion that requires no risk tolerance beyond what you already have, no investment products, and no financial advisor. Just one recalibration based on a number that the math has always supported, but conventional wisdom never got around to mentioning. 3 things are going to shift for you by the time this video ends. First, you will understand the precise mechanism that makes excess savings destructive rather than protective. Not in theory, but in the context of the current rate and inflation environment that is active right now. Second, you will have a formula, a simple 2-variable calculation that produces your personal savings ceiling based on your own monthly expenses, not a generic number pulled from a listicle written by someone who has never seen your bank statement. Third, and most importantly, you will know what to do with every dollar that sits above that ceiling, specifically where it belongs instead, expressed in terms of risk level, liquidity, and the realistic return differential that justifies moving it out of cash. To understand why the savings ceiling is not a personal finance opinion, but a mathematical certainty, we need to look at 3 distinct economic environments where the same disciplined saver, same income ratio, same savings habit, same risk aversion, produced 3 dramatically different outcomes purely based on how much cash they kept liquid versus deployed. Japan between 1995 and 2005 is the clearest case study in modern economic history of what happens when a culture of aggressive saving meets a zero-rate, deflationary environment. And the answer is not what the savings habit deserved, because the environment had changed the rules without updating the playbook. The United States, between 2010 and 2020, represents the opposite extreme. A decade of historically low rates combined with an equity market that compounded at an average of 13.6% annually, creating the largest peacetime wealth gap in American history. Not between the reckless and the responsible, but between those who understood cash drag and those who did not. The Eurozone, from 2015 to 2024, sits in the middle. Negative nominal rates for a significant portion of that period, meaning savers in Germany, the Netherlands and Austria were literally charged a fee by their banks for the privilege of keeping money on deposit, a condition that broke every intuitive assumption about what saving money is supposed to accomplish. In Japan's lost decade, the average disciplined household saver put away the equivalent of $84,000 over 10 years, a genuinely impressive savings rate by any global standard, and ended that decade with real purchasing power growth of just 0.3%. Not because their savings rate was wrong, but because they kept an average of 9.2 months of expenses in liquid cash throughout the entire period. The 9.2-month cash buffer felt responsible. Japan's culture of financial conservatism made it feel not just responsible, but virtuous. But against a deflationary backdrop where prices were falling and rates were at zero, every yen sitting in a savings account was a yen not compounding anywhere else. And that dead weight accumulated into a decade-long opportunity cost of approximately $31,000 per household. The households that outperformed, and they exist, they are documented in Bank of Japan household surveys from that period, were not the ones who took more risk. They were the ones who kept a leaner cash buffer, specifically between 3 and 4 months of expenses, and redeployed everything above that ceiling into low-risk instruments that still outpaced cash by 2.1 percentage points annually. 3 to 4 months. That number appears again and again across different economies, different rate environments, different cultural contexts. It is not arbitrary. It is the product of a specific calculation, and we are going to build that calculation from the ground up in the next section. The American case between 2010 and 2020 is where the numbers become genuinely uncomfortable, because this was a decade of historically favorable conditions, low inflation, low rates, and a broad market that rewarded any deployment of excess cash above the savings ceiling with outsized returns relative to the risk taken. The median American household that kept 8 months of expenses in a standard savings account throughout that decade, which represented the behavioral norm, the thing financial culture broadly endorsed as safe, ended 2020 with approximately $67,400 less in net worth than an identical household that kept 3.5 months liquid and systematically redeployed everything above that threshold into a simple, low-cost index structure. $67,000. Not from taking more risk. Not from picking winning stocks. Not from timing the market. From simply knowing where the ceiling was and not treating the space above it as a comfort zone that the math could not afford to sustain. And critically, this gap did not require any financial sophistication to close. It required one decision, made once, recalibrated annually. The complexity was always in the fear of acting, never in the action itself. Across all 3 economies, the pattern holds with remarkable consistency. The real return differential between money kept in a standard savings account and money deployed into the next tier of low-risk instruments averages between 2.1% and 8.3% annually, depending on the economic environment and the specific instruments available in each market. Even at the conservative end of that range, the Japanese scenario, the most sluggish economic environment in modern developed world history, a 2.1% annual differential on $30,000 of excess cash above the savings ceiling compounds to just over $16,800 in additional real wealth over 10 years. That is not a rounding error. That is a car, a year of college tuition, or 3 years of funded retirement contributions. The Eurozone number, 3.7% differential, reflects the unique condition of negative nominal rates, where the gap is partly driven by the cost of holding cash rather than purely the opportunity cost of not deploying it. German savers who kept excess cash in standard accounts during the negative rate period were not just missing returns, they were paying a structural penalty for a behavior their entire financial upbringing had taught them was correct. The common thread across Japan, the US, and the Eurozone is not the size of the gap. It is the mechanism that creates it. Cash drag operating above the savings ceiling. And that mechanism is just as active in your account right now as it was in every one of these case studies. Every economy, every rate environment, every cultural savings tradition converges on the same structural truth. There is a floor below which your liquid cash reserve is genuinely protective, absorbing job loss, medical emergencies, and unexpected large expenses without forcing you into debt or asset liquidation at the wrong moment. And there is a ceiling above, which every additional dollar of liquid cash is not protection. It is inertia. It is the financial equivalent of keeping a second fire extinguisher in every room of your house because the first one made you feel safe. The marginal utility of excess cash drops to zero, and then it goes negative as cash drag begins compounding against you. Japan, the US, and the Eurozone all tell the same story with different numbers. The floor is real. The ceiling is real. And the space between them, the zone where your savings account is genuinely doing its job, is almost certainly smaller than the amount you currently have sitting in. In the next section, we're going to meet two people who started in identical financial positions. One of them found the ceiling. One of them never looked for it. 10 years later, the distance between them is a number that will stay with you for a long time. Marcus and Diana are not a cautionary tale about recklessness versus responsibility. They are both responsible. They both have stable jobs, no consumer debt, and a genuine commitment to financial discipline, which is exactly what makes this comparison so important. Because the gap that opens between them over the next decade has nothing to do with effort, income, or risk tolerance. They are 34 years old, earning identical salaries of $72,000 per year, with monthly expenses of $3,800 and an existing savings account balance of $41,000 each, built up carefully over several years of consistent saving. By any conventional measure, both of them are doing everything right. One of them just knows one thing, the other does not. Marcus has internalized the conventional wisdom perfectly. Keep as much as possible in savings, prioritize security, do not risk what you have worked hard to build. His $41,000 represents just under 11 months of expenses, and it makes him feel genuinely secure every time he checks his balance, which he does regularly because the number is reassuring. Diana ran the same calculation Marcus did. 11 months of expenses in savings. And then she looked up the current real yield on her savings account, compared it to the inflation rate printed in that month's Consumer Price Index release, and made one adjustment. One number changed. Everything else stayed identical. Diana's savings ceiling calculation was straightforward. Monthly expenses of $3,800 multiplied by 3.5. The upper boundary of the protective zone supported by the data we examined across Japan, the US, and the Eurozone, producing a liquid cash target of $13,300. Every dollar above that number was identified as excess cash, subject to cash drag, and redeployed into a laddered short-term bond structure yielding a blended 4.8% annually. Instruments with liquidity windows of 30 to 90 days. Not locked up, not risky, just not sitting idle. Marcus's entire $41,000 sits in a standard high-yield savings account at 1.3% APY. That rate sounds competitive when the bank advertises it. Against an inflation environment running at 4.1%, It represents a real yield of negative 2.8%, meaning Marcus is not earning 1.3% on his savings. He is losing 2.8% of purchasing power annually while watching a number go up and calling it growth. In year one, the difference is not dramatic. Diana's deployed $27,700 earns approximately $1,330 more in real terms than Marcus's equivalent cash position. Marcus barely notices. Diana barely celebrates. The gap in year one is the size of a weekend trip, and neither of them is thinking about it in those terms. But year one is not where this story lives. Year one is just where the compounding clock starts. By year 5, Marcus's savings account has grown to $46,800, a genuine increase, the product of continued contributions and compound interest at 1.3%. He feels good about this number. It represents years of discipline, and he is not wrong to feel that way. What he cannot see is the purchasing power erosion running silently beneath the surface, trimming the real value of every dollar he has saved. Diana's equivalent position at year 5 sits at $71,200. The same contributions, the same discipline, the same risk aversion, but with $27,700 compounding at 4.8% blended rather than 1.3%, and with the annual surplus above her ceiling being redeployed systematically rather than accumulated as additional cash drag. She has not taken a single investment risk that Marcus has not also been offered. She has simply declined to pay the cash drag penalty. At year 10, Marcus has $52,400. Diana has $98,700. The gap is $46,300, and that number does not include the secondary effects of Diana having had more deployed capital available for opportunistic redeployment during market dislocations in years 4 and 7, which in a realistic scenario would push the real gap closer to $58,000 to $62,000. $46,000. Generated not by risk, not by expertise, not by luck, by knowing one number, the savings ceiling, and making one structural adjustment on a single afternoon 10 years ago. The most uncomfortable part of this comparison is not the dollar amount. It is the invisibility of the cost. Marcus never received a bill for $46,300. No bank sent him a statement showing a line item called cash drag penalty. His balance went up every year, his financial behavior was praised by everyone around him, and the loss accumulated in complete silence, expressed not as a deduction but as an absence of growth that never announced itself. Diana did not discover some secret investment product. She did not take on volatility that would have kept her up at night. Her deployed capital above the ceiling sat in instruments rated investment grade, with liquidity windows short enough that she could access the money within 30 to 90 days if a genuine emergency required it. The protection Marcus valued was still present in Diana's structure. It was just right-sized, rather than oversized. The conventional wisdom that led Marcus to his outcome, keep as much as possible in savings, more is always safer, was built for a world where savings accounts returned real yield. The current environment, following that advice, does not make you safer. It makes you the person quietly funding the spread between what your bank pays you and what your bank earns by lending your deposits out at a multiple of that rate. Marcus is not a cautionary tale about bad decisions. He is a cautionary tale about good decisions that expired, and the importance of knowing when the rulebook changed. The formula Diana used is not proprietary. It is not complicated. Monthly expenses multiplied by 3.5 produces the savings ceiling for the median household in a stable, dual income or high job security environment. The upper boundary of the protective zone, above which every additional dollar of liquid cash begins generating negative real returns relative to the next available tier of low-risk, high-liquidity instruments. The multiplier adjusts for household risk profile in two specific directions. Single-income households, or those with elevated job loss risk, should extend the ceiling to 4.5 months, because the protective function of liquid cash is doing more work, and the cost of being wrong about liquidity is higher. Dual-income households with stable employment and accessible credit lines can compress to 3.0 months without meaningfully increasing their vulnerability to genuine emergencies. At $3,800 in monthly expenses, Diana's ceiling was $13,300. If your monthly expenses are $4,500, your ceiling is $15,750. If they are $6,000, your ceiling is $21,000. The number is specific to you, not to a generic financial archetype, and it takes approximately 4 minutes to calculate with nothing more than your last 3 months of bank statements and a basic calculator. Everything above that number, every dollar currently sitting in your savings account above your personal ceiling, is the number we need to talk about next, because that is where the insight lives, and that is where the one action this video is building toward finally comes into focus. The insight this entire video has been building toward is not save less. That framing misses the point entirely and produces the wrong behavior. The insight is that your savings account has a job, and like any job, it has a scope, a defined set of responsibilities it is specifically designed to handle. And when you ask it to do work beyond that scope, it does not just underperform, it actively costs you money in real terms every single month it is overloaded. The job of your savings account is emergency liquidity, covering 3 to 4 months of essential expenses in the event of job loss, medical disruption, or a large unexpected cost without forcing you into debt, asset liquidation, or financial panic. That job is real, it is important, and the dollars assigned to it are genuinely earning their keep by providing insurance against the kind of financial shock that derails long-term wealth building far more effectively than cash drag does. Every dollar above the ceiling is not doing that job. It is not providing additional emergency coverage in any meaningful sense. Your 4th month of liquid expenses does not protect you meaningfully more than your 3rd, and your 9th month does not protect you meaningfully more than your 4th. Past the ceiling, additional cash is not insurance. It is inventory that has nowhere to ship, sitting in a warehouse you are paying rent on while the goods inside slowly lose value. The move is not dramatic. It does not require a brokerage account, a financial advisor, or a risk tolerance conversation. It requires identifying your ceiling, calculating your excess, and moving that excess one tier up the liquidity ladder into instruments that still protect you from emergencies but stop charging you the cash drag penalty for the privilege of that protection. Tier 2 is not the stock market. It is not crypto. It is not real estate. It is the category of instruments that exists specifically in the gap between a savings account and a long-term investment. Instruments designed to hold capital that needs to remain accessible within a 30 to 90-day window while generating a real yield above the inflation rate, which a standard savings account in the current environment categorically cannot do. A high-yield money market fund currently returns between 4.2% and 5.1% annually, with liquidity measured in 1 to 2 business days, meaning if a genuine emergency materializes, your excess capital above the savings ceiling is accessible within 48 hours, not locked up, not at risk, not subject to market volatility in any meaningful sense. The yield differential versus a standard savings account at 1.3% is not a rounding error. It is 2.9 to 3.8 percentage points of additional annual return on capital that is functionally just as liquid as what you already have. A short-term treasury ladder, purchasing 3-month and 13-week treasury bills on a rolling basis, returns between 4.6% and 5.3%, with the full backing of the federal government, a risk profile so low that institutional cash managers use it as their benchmark for capital preservation. The liquidity window is slightly longer than a money market fund, but for excess capital above your savings ceiling, money that is not your emergency fund, money that was never going to be needed in the next 72 hours, that window is entirely acceptable. The specific instrument matters less than the decision to move. Any one of these four options closes the majority of the cash drag gap that separates Marcus from Diana. The exact yield differential between them is smaller than the yield differential between all four of them combined, and a standard savings account sitting below the inflation rate. The one action this video has been building toward takes approximately 25 minutes to complete today. Not next week, not after you have done more research, not after you have had a conversation with a financial advisor about whether you are ready. Today, because every additional month your excess cash sits below the inflation rate, is a month of cash drag that does not reverse, does not refund, and does not care that you were planning to get around to it eventually. Step 1 takes 4 minutes. Pull your last 3 months of bank statements, calculate your average monthly essential expenses, multiply by 3.5, and write that number down. That is your ceiling. That is the number that defines the boundary between your savings account doing its job and your savings account costing you money. Write it down with the same seriousness you would write down a bill payment date, because the math treats the deadline with exactly that level of indifference. Step 2 takes 30 seconds. Subtract your ceiling from your current savings account balance. The result is your excess. That is the number that has been generating negative real returns in your account, compounding cash drag against your long-term financial position every single month. And it is almost certainly larger than you expected it to be, because the conventional wisdom that built your savings habit never told you to look for it. Step 3 takes 15 to 20 minutes. Open a brokerage account if you do not already have one. Select a money market fund or initiate a treasury bill purchase through your existing bank or brokerage and transfer your excess. Not all of your savings, not your emergency fund. Just the number from step 2, the excess above the ceiling, moving from a position of negative real yield into a position of positive real yield, with liquidity intact and risk profile unchanged. The total annual swing from negative real yield on excess cash to positive real yield on the same capital is not measured in percentage points. It is measured in dollars, and those dollars compound. The household that makes this one structural adjustment today does not just stop losing $1,148 annually to cash drag. It starts gaining $859 annually from Tier 2 deployment, a total swing of just over $2,000 per year on a capital base that has not changed in size, risk profile, or accessibility. Over 10 years, with consistent redeployment of new excess above the ceiling as income and savings grow, that annual swing compounds into a gap that rhymes closely with the $46,300 difference we saw between Marcus and Diana. Not because the math is circular, but because the math is consistent. The mechanism is the same. The formula is the same. The only variable is whether you know the ceiling exists and act on that knowledge. The current macro environment makes this adjustment more urgent than it has been at any point in the last 15 years. Real yields on savings accounts are negative across the majority of developed economies. Tier 2 instruments are yielding at their highest real rates since 2007, and the gap between doing nothing and doing this one thing is at a historical wide. The window where this adjustment generates maximum return differential is open right now, and windows like this have a documented history of closing without announcement. This is not about becoming an investor. It is not about taking on risk you are not comfortable with. It is about giving capital that is already yours, already saved, already disciplined, the environment it deserves to sit in, rather than the environment that was designed in a different era for a different interest rate world that no longer exists. The compounding argument for acting today rather than after further research is not motivational language. It is arithmetic. Every month of delay on a $27,700 excess above the savings ceiling costs approximately $71 in foregone real yield differential. That number sounds small. Over 12 months of delay, it is $852. Over 24 months, it is $1,740. And that figure does not account for the compounding of the missed returns themselves, which push the true cost of a 2-year delay closer to $1,900. The research paralysis that keeps most people from making this adjustment is not irrational. It comes from a genuine desire to make the right decision, which is exactly the right instinct applied to exactly the wrong timeline. The research was done. Japan did it. The United States did it. The Eurozone did it. The data from 3 major economies across 3 distinct rate environments all point to the same ceiling, the same mechanism, and the same outcome for households that find it versus households that do not. The insight is not complex. The action is not complex. The only complex part was understanding the macro mechanism well enough to trust that the simple action is actually the right one. And that is exactly what this video was built to give. Remember that number from the opening. 68% of your savings account silently losing real value. Not from theft, not from a crash, but from the simple act of keeping more liquid cash than the math can justify in the current rate environment. That number has not changed for the 340 million people who watched this video and kept scrolling without acting. For you, as of today, it is a problem with a known solution and a 25-minute fix. The macro conditions that created this situation, central banks holding rates below real inflation, the gap between savings account yields and Tier 2 instrument yields sitting at a 15-year wide, the $14.7 trillion of excess cash sitting in low-yield accounts across the developed world. None of that is resolved by one person calculating their ceiling and moving their excess. But your personal exposure to those conditions is entirely within your control, starting today. 340 million people in the trap are not there because they made bad decisions. They are there because the conventional wisdom that governs savings behavior was written for a world that no longer exists. And nobody sent a memo when the rules changed. You have now received that memo, expressed not as advice, but as the arithmetic of 3 economies, 2 households, and 1 formula that takes 4 minutes to run. The silent tax on excess savings does not stop collecting because you understand it. It stops collecting because you act on that understanding. And the distance between understanding and acting is exactly 25 minutes and 1 transfer. Marcus and Diana were not fictional characters introduced to make a point feel warmer. They were a mathematical demonstration of the only variable that separates 2 identical financial trajectories over a decade: knowledge of the ceiling and the decision to act on it. The jar labeled U sits exactly where Marcus's jar sits right now, for most people watching this video. The arrow pointing it toward Diana's outcome is not motivational metaphor. It is the direction the math points when you run the formula. Your savings account did not fail you. It did the job it was designed to do. It held your emergency fund safely, kept it liquid, and protected you from the kind of financial shock that derails long-term wealth building. The problem was never the savings account. The problem was the scope creep, the slow accumulation of capital above the ceiling that the account was never designed to manage, earning the savings account rate on dollars that deserved the Tier 2 rate. Closing that scope creep does not require a new financial identity. It does not require becoming an investor, taking on risk, or fundamentally changing your relationship with money. It requires one recalibration, a ceiling calculation, an excess identification, and a single transfer that right-sizes the job your savings account is doing and gives the excess capital the environment it has earned the right to sit in. Diana did not become Diana overnight. She became Diana on one specific afternoon, when she ran 4 minutes of arithmetic, identified a number, and moved it. That afternoon is available to you right now. The one sentence worth carrying out of this video is not a formula, and it is not a product recommendation. It is this: your savings account is a tool with a specific job, and every dollar you keep in it above the ceiling is a dollar paying you to do a job it was never hired for. in a currency that inflation is quietly devaluing every single month it sits there. The macro environment that makes this adjustment urgent: negative real yields on savings accounts, Tier 2 instruments at 15-year yield highs. The widest cash drag gap since 2007 will not persist indefinitely. Rate environments shift. The window where this specific recalibration generates maximum return differential is open now, and the households that act inside this window will carry a structural advantage into whatever rate environment follows. The calculation is 4 minutes. The transfer is 20 minutes. The compounding impact, expressed in the arithmetic of Diana's trajectory versus Marcus's, in the $46,300 gap that opens over 10 years from one structural adjustment made on one afternoon, runs for as long as you let it run, and it starts the moment the excess leaves the savings account and enters the environment it deserves. If this framework shifted something for you, if the ceiling number you calculated looks different from the balance currently sitting in your savings account, the next video in this series breaks down exactly how to build a Tier 2 ladder from scratch, starting with zero prior investment experience and finishing with a structure that would have closed the Marcus-Diana gap at every point in the last 15 years. That video is queued up next. The arithmetic continues there. $14.7 trillion sitting in excess savings accounts across the developed world. Every dollar of it subject to the same cash drag mechanism. Every household holding it subject to the same silent tax. The macro condition is systemic, and it is not going away on its own. But your exposure to it is a calculation, a ceiling, and a transfer away from being a different kind of problem entirely. The economies that recover purchasing power fastest from periods of negative real yields are not the ones with the most sophisticated investors. They are the ones where the largest number of ordinary households understand the ceiling, calculate the excess, and make the move, shifting the aggregate weight of $14.7 trillion from cash drag territory into instruments that compound rather than erode, one household at a time, at whatever pace the arithmetic makes undeniable. You now know the ceiling. You know the formula. You know the mechanism that makes excess savings destructive rather than protective in the current rate environment. And you know the exact category of instruments that closes the gap without adding risk, reducing liquidity, or requiring a financial identity you have not already earned through years of disciplined saving. The math is patient. It will compound in whichever direction you point it, toward Diana's outcome or toward Marcus's, with complete indifference to which one you intended. The only variable it responds to is the decision you make today about where the ceiling sits and what happens to the dollars above it.